9 people walked into a room this week. No cameras, no public gallery, no live stream. They sat down, reviewed some documents, argued quietly for a few hours, and then voted. And just like that, your mortgage payment, your energy bill, your ability to save anything at all shifted. You did not vote for these people. You cannot remove them. Most Britons could not name a single one of them, and yet what they decided affects 67 million people more directly than almost any law Parliament has passed this year. This is the Bank of England's Monetary Policy Committee, and this week they made their decision. Here is what they chose, and here is what it will cost you. Why this matters now. To understand why this particular decision matters more than usual, you need to understand the position Britain is in right now. 18 months ago, things were improving. Inflation was falling. The bank had cut interest rates 6 times in a row. By December 2025, the base rate sat at 3.75%. Not great, but moving in the right direction. People with mortgages started breathing again. Then, the Middle East conflict escalated. Oil supply chains fractured. Petrol prices jumped nearly 24 pence per liter in under 3 months. Gas prices spiked, and inflation, which everyone had quietly declared defeated, started climbing back. The Bank of England now expects inflation to reach 6.2% by early 2027. That is more than 3 times their target. So this week's meeting was not routine. It was a genuine crossroads. Hold rates and risk inflation embedding itself into the economy, or raise them and risk tipping an already fragile economy into recession. 9 people, 1 vote, 67 million consequences. How the system works. The Monetary Policy Committee, the MPC, meets roughly 8 times a year. Each member reviews the same economic data: growth figures, inflation numbers, employment statistics, global energy prices, and then they vote on where to set the base rate. The base rate is the interest rate the Bank of England charges other banks to borrow money overnight. Those banks then pass that cost on to you through your mortgage, your business loan, your credit card, your savings account. When the base rate goes up, borrowing becomes more expensive across the entire economy. People spend less, businesses invest less, demand falls, and in theory, prices stop rising as fast. That is the mechanism, simple on paper, but here's what the textbooks leave out. Raising interest rates does not lower the price of oil. It does not end a war. It does not fix a supply chain. It does not make energy cheaper or food more affordable. What it does, very efficiently, is make your debt more expensive while the underlying problem continues entirely unchanged. The Bank of England is essentially trying to cool a fever by making the patient run a marathon. The fever's still there, the patient is just more exhausted. The uncomfortable math. This week, the MPC voted to hold rates at 3.75%, for now. But the language coming out of Threadneedle Street suggests that hold may not last long. JP Morgan is forecasting a rise to 4% before the end of the year. Some analysts see it going higher still. So let us do the math that nobody in the press conference does for you. The average UK mortgage balance is around £230,000. On a standard 25-year repayment deal, every 1 percentage point in interest rates adds approximately £115 to your monthly payment, every single month. For a family already spending 30% more on energy than they were 2 years ago, already watching the weekly food shop quietly expand without buying anything different, an extra £115 a month is not an inconvenience. It's a structural change to how they live. The bank calls this the necessary transmission of monetary policy. Most people call it something considerably shorter. What they say versus what they mean. After every MPC meeting, the governor of the Bank of England holds a press conference. The language is always careful, measured, slightly hypnotic in its precision. They say things like, "We remain data-dependent. We are monitoring second-round effects. The outlook is highly uncertain. We stand ready to act if necessary." Translated into plain English, this means, we don't know what's going to happen, we're watching the same numbers as you are, and we'll react when we have to. That's not a criticism. The uncertainty is genuine. A war in the Middle East is not something the Bank of England can model with confidence. Oil prices could fall next month, the conflict could de-escalate, inflation could peak and retreat faster than expected. But here's what's also true. The IMF just gave the UK its largest growth downgrade of any G7 nation, cutting the 2026 forecast from 1.3% to 0.8%. Less than 1% growth. In a country where real wages have barely moved, where public services are stretched, and where the cost of simply existing has risen faster than at any point in a generation. Bigger implications. The ripple effects of sustained high rates are already visible. Business investment is stalling. Companies that were planning to expand are waiting. Companies that were waiting are quietly shelving plans entirely. When businesses stop investing, they stop hiring. When hiring slows, unemployment rises. The Item Club, one of Britain's most respected independent forecasting groups, predicts unemployment could reach 5.8% by mid-2027. That's nearly 250,000 more people without work. Not because of anything they did, not because the economy fundamentally broke, but because oil got expensive, a war continued longer than expected, and the institution designed to manage inflation had one lever to pull and a very complicated problem to solve. There's a particular kind of irony in the fact that the people most harmed by rate rises are rarely the people who caused inflation in the first place. The 9 members of the MPC made their decision this week. Hold, watch, wait. And the British economy will absorb it, as it always does, quietly, incrementally, one mortgage payment at a time. But the question that no press conference will ever answer directly, the question that actually sits at the center of all of this, is a simple one. When a central bank's only real tool is to make life harder for ordinary people in order to fix a problem that ordinary people did not create, is that a monetary policy, or is it just the nearest available excuse?